Stop scrolling for 1 second, because if you are holding gold or silver right now, or you are thinking about buying, what I am about to show you can change your next move completely. Gold just touched over $4,000 an ounce, and silver, after hitting an all-time high earlier this year, has fallen hard in the last few weeks. Something big is happening behind the scenes, and most people are not talking about the real reason. Stay with me till the end, because I am going to break down the exact numbers, the exact reason behind this move, and where I personally think price is heading next. If you skip the middle part, you will miss the one number that tells you whether this is a buying opportunity or a trap. Before we go further, let me quickly say this. If you are new here, this channel is only about one thing: gold and silver, nothing else. No random topics, no noise. Just clean, honest metal market analysis every single day. So if that is something you need in your life, do one small favor for me. Hit that subscribe button and turn on the notification bell, because tomorrow's video might be about the number that decides your next trade. Also, drop a comment below and tell me, are you currently holding gold, holding silver, or waiting on the sidelines? I read every comment, and it genuinely helps me know what to cover next. My name is your host on Metal Market News, and I have been tracking gold and silver as a dedicated analyst, going through spot prices, central bank data, and global economic reports every single day so that you don't have to. Today's topic is simple but important. Where do gold and silver stand right now? Why did silver crash after making history? And what does the road ahead look like for both metals? Let's start with the numbers, and these are live, verified spot prices as of this week. Gold is trading close to $4,031 per ounce, based on live bullion market data. Just a few days earlier, it was even touching around $4,080 intraday before pulling back. Silver, on the other hand, is trading around $56.63 per ounce right now. That might sound like a strong number, but here is the shocking part. Silver was trading above $121 per ounce back on January 29th this year. That is its all-time record high in history. From that peak, silver has now dropped more than 50%. Gold has not fallen anywhere close to that. Gold actually made its own all-time high this year too, touching above $5,500 per ounce in late January, before correcting down to where we are today. So right now we have two of the biggest precious metals in the world, both coming off record highs from earlier this year, both correcting hard, but silver correcting far more violently than gold. This gap between how gold is behaving and how silver is behaving is the real story today, and it tells us something important about where money is flowing in the global market right now. Now let's go into the background, because to understand where price is going, you first need to understand how we got here. 2025 was an extraordinary year for gold. According to the World Gold Council, gold set 53 new all-time highs in that single year, and the total gold held by central banks crossed 5,000 tons for the first time in recorded history. The average price of gold rose 44% over the year, closing around $3,431 per ounce. That kind of central bank buying is not normal. Central banks were not buying gold as a small-side investment. They were buying gold because trust in paper currency and government bonds was shaking, especially with inflation staying stubborn and interest rate policy becoming unpredictable. Then in January this year, that buying pressure exploded into a full-blown rally. Gold shot past $5,000 and even touched an all-time record above $5,500 per ounce. Silver, being the smaller and more volatile metal, moved even faster. Silver broke the historic $50 ceiling for the very first time ever. Remember, silver had only touched near $50 twice before in all of history. Once in 1980 during the Hunt brothers' famous attempt to corner the silver market, and once again in 2011. Both times it failed to hold and crashed straight back down. This time, in January 2026, silver didn't just touch $50, it blew straight through it and kept climbing all the way to $121.58. That is not a normal move for any commodity. That is a historic mania-level spike. Big brokerage firms were extremely bullish through this period. JP Morgan, one of the largest banks in the world, publicly forecast that gold could reach $6,300 by the end of 2026, driven by continued central bank diversification away from paper assets and into real physical assets like gold. That kind of prediction from a major institution added even more fuel to the rally, and retail investors around the world rushed in, afraid of missing out on the biggest precious metals bull run in modern history. But here is the important part of the background story. Rallies that move this fast, this far, in this short amount of time, almost never go straight up forever. Silver's move from around $36 in July last year to $121 in January this year was one of the fastest percentage gains any major commodity has shown in decades. When a market moves that fast, profit taking becomes inevitable. Big holders start locking in gains, leverage gets stretched thin, and any small piece of negative news becomes an excuse for a sharp pullback. That is exactly the setup that was building before the correction we are now living through. So what actually triggered the drop? This is the problem we need to unpack carefully, because it is not just one single event. It is a combination of three pressures hitting the market at the same time. The first pressure is interest rate expectations. Stronger than expected, United States economic data has been coming out recently, and that has pushed Treasury yields higher. When yields on safe government bonds go up, gold and silver become less attractive, because these metals don't pay any interest or dividend. Investors start asking, why hold silver at zero yield when I can get a solid return from a bond instead? That single shift in mindset has been enough to pull real money out of precious metals in the last 2 weeks. The second pressure is the US dollar getting firmer. Gold and silver are priced in dollars globally, so when the dollar strengthens, it takes fewer of those stronger dollars to buy the same ounce of metal, which naturally pushes the price down. Traders have also been pricing in the idea that the Federal Reserve, under Chair Kevin Warsh, may keep interest rates elevated for longer than the market originally hoped, and that hawkish tone has weighed heavily on both metals through the middle of July. The third pressure, and this one is very important, is geopolitical. There has been serious escalation in the Middle East recently, including reported strikes and rising tension involving Iran, which pushed oil prices higher. Normally, rising geopolitical tension should support gold and silver as safe haven assets. But this time, something different happened. The market got worried that higher oil prices would push inflation back up, which in turn increases the chance that the Federal Reserve keeps rates high for even longer. So paradoxically, the same geopolitical tension that usually helps gold ended up hurting it in the short term, because the interest rate fear outweighed the safe haven demand. Put all three of these together: rising yields, a stronger dollar, and rate fear triggered by Middle East tension, and you get exactly what we saw. Silver plunged more than 3% in a single session and dropped to its lowest level since November last year, briefly slipping below $56. Over just the past week alone, silver was on track to lose more than 7% of its value. Silver is now down close to 21% since the start of this year, even though it is still up roughly 48% compared to the same time last year. Gold has held up noticeably better through all of this, only pulling back a small percentage from its recent highs, which tells us institutional money is still treating gold as the safer of the two metals right now, while silver, being smaller and more speculative, is taking the harder hit. Now let's move into the real content and analysis, because numbers without context don't help you make a decision. Let's look at gold first. Even after this recent pullback, gold at around $4,031 per ounce is still sitting on massive long-term strength. Over the past 5 years, gold has appreciated more than 120%, actually outperforming the S&P 500 over that same stretch. That tells you this is not some short-term trend. This is a structural shift where big money, especially central banks, are permanently rotating a portion of their reserves out of paper currency and into physical gold. As long as that central bank buying continues, and current data from the World Gold Council shows it is continuing at record pace, gold has a strong floor underneath it, even during corrections like this one. Now let's analyze silver, because silver's story is more complicated. Silver is not just a monetary metal like gold, it is also an industrial metal. It is heavily used in electronics, solar panel manufacturing, and medical equipment. This dual identity is exactly why silver moves so much harder in both directions compared to gold. When speculative money floods in expecting a monetary crisis, silver flies up even faster than gold because the physical silver market is much smaller than the gold market, so it takes less money to move the price dramatically. But when that same speculative money runs for the exit, silver falls even harder, because that industrial demand base alone cannot support prices that were built on pure speculation. That is exactly what we are watching unfold right now. The mania phase built silver up to $121, and now the unwind is bringing it back down toward more sustainable levels near $56. Something else worth analyzing is the gold to silver ratio, which is simply how many ounces of silver it takes to buy 1 ounce of gold. Right now, with gold near 4,031 and silver near 5663, that ratio sits at roughly 71 to 1. Historically, this ratio has swung between around 15 to 1 during silver's strongest periods and over 100 to 1 when silver is deeply out of favor. A ratio around 71 suggests silver is still somewhat undervalued compared to gold on a historical basis, even after the huge run-up earlier this year, but it is nowhere near as extreme as it was during past bottoms. This ratio is one of the most important tools serious metal traders watch, because it tells you which metal has more room to catch up. One more thing worth noting from a supply and demand angle. Mine production for gold globally has stayed almost flat, growing only around 1 to 2% per year according to recent industry data, while demand from central banks and tariff-related buying pressure in certain regions keeps climbing. This mismatch between flat supply and rising demand is often called the scarcity loop, and it is one of the core structural reasons some major analysts believe gold still has significant upside room left this year, even with short-term pullbacks like the one we are seeing now. Now let's talk prediction, because this is what you have been waiting for. I want to be upfront with you. Nobody, including me, can predict the market with 100% certainty, and anyone who tells you otherwise is not being honest with you. But based on the data we have gone through today, here is my honest read as an analyst. For gold, the medium-term picture still leans bullish. JP Morgan's public forecast of $6,300 by the end of this year is aggressive, but even more conservative forecasts from other analysts place gold somewhere in a range that still sits well above where we are trading today, as long as central bank buying continues at its current pace and interest rate policy doesn't turn sharply against precious metals. Short term, though, gold could still see more choppy, sideways to slightly lower price action if the US dollar keeps strengthening and if the Federal Reserve continues signaling a hawkish, higher for longer stance. For silver, I expect more volatility than gold in the near term. The support zone many traders are watching sits somewhere between $50 and $56, roughly where the market found strong resistance turned support twice before in history. If silver holds above that $50 zone and doesn't break down through it, that would be a strong technical signal that the bigger uptrend is still intact, and this is simply a healthy correction after an overheated rally. But if silver breaks clearly below $50 with strong volume, that would be a warning sign that more downside could follow before the next real buying opportunity appears. Given silver's industrial demand base in solar and electronics continues growing steadily worldwide, I personally lean toward this being a correction within a larger bull market rather than the end of the story, but this is exactly the kind of moment where patience and proper risk management matter more than emotion. I want to remind you clearly, everything I shared today is based on verified, latest available market data as of the time of recording, pulled from live spot price sources and recognized market data providers. But gold and silver prices move constantly, sometimes by the minute, so please always check a live spot price before making any decision and do your own research before you put your money anywhere. I am not a financial advisor, I am simply an analyst sharing data and my personal read on it, and the final decision and responsibility is always yours. If today's breakdown gave you real clarity on what is happening in the gold and silver market, that is exactly what this channel is built for. Hit subscribe if you haven't already, tap the like button so this reaches more people who need to see real numbers instead of hype, and drop a comment telling me which metal you think will move first, gold or silver. I read and reply to as many comments as I can. Tomorrow we go even deeper into the charts, so I will see you in the next video right here on Metal Market News.